we're going to start an entire series on the options Greeks. One of the most important components of options trading is understanding the optimal environment to buy or sell, or to understand if time is on your side, and all of the components that make up an options premium. The key to understanding this is really understanding the Greeks. So join us as we do a deep dive into each individual Greek. Why do we study the Greeks? First of all, options pricing. An option is priced by more than just the underlying security. External factors affect the options price as well, like time and implied volatility. And the option Greeks can give us an idea by how much, or the positive and the negative effects. Second is strike selection. So in order to comprise or create your option strategy, we have to choose optimal strikes and expirations in addition to an optimal environment. And we utilize the Greeks to help us choose and define the contracts that we're going to create within our strategy. And then the third is position management. If you combine option Greeks or even a whole portfolio, the Greeks can tell us if we have a bearish or a bullish or even a neutral bias, and give us an indication of when we should close our contract. Let's do a quick review of how an option is priced. So in this example, we have the underlying security ABC trading at $103 per share, and we have an ABC 100 strike call that expires within 30 days, and that's trading at $5 per share. Well, an options premium is made up of intrinsic value and extrinsic value. Intrinsic value really means the executable value, or the in-the-money value of the option contract. And remember, that could even be zero. The extrinsic value component is made up of time value and implied volatility. So since this contract contains the right to buy ABC at $100 per share and ABC is at 103, then that means the intrinsic value of this contract is at least $3 per share, because I can exercise my rights to buy ABC at 100 and immediately sell at the market at 103. Anything in excess becomes the extrinsic value, or the external factors that affect the options price. And in this case, that's the remaining $2 to make up the entire $5 premium. I'm going to explain to you the option Greeks without even using one of the Greek words. And this is because we're going to look at the events that affect an options premium. And let's look at a long call versus a long put. So if the underlying security moves above the strike price, this has a positive effect on a long call and a negative effect on a long put. That makes sense, because the long call contains the right to buy. If the underlying security is higher than the strike price, or that agreed price that we can buy at, the long call is going to be more valuable. And of course, the long put is going to be less valuable because it contains the right to sell. Now, if the stock moves below the strike price or down below, then the inverse happens. The long call is less valuable and the long put is more valuable. If there's less time until expiration, both the long call and the long put are less valuable. And that makes sense. Time is moving against us. So as the option nears expiration, that long option, we want to be able to sell it to close at a higher price. And as time moves on, it makes the option less valuable. Therefore, it has a negative effect on long options. Now, if there's an anticipated movement, for example, earnings, that makes long calls and long puts more valuable, because there is an anticipated movement in the underlying security in either direction. Earnings is such a great example of that. So therefore, that makes the options premium more expensive, and subsequently, options that we're buying will be more valuable. Let's look at delta. By delta's definition, it tells us how much an options premium will move if the underlying security, stock, or ETF moves up or down by $1. So that's really the definition, but how do we actually use delta? And delta, interestingly enough, is probably one of the most important Greeks to understand and has the most uses. Let's look at how delta is measured. Delta is on a scale from -1 to +1. Bullish strategies have a positive delta and bearish strategies have a negative delta. Any neutral strategies are going to have a delta really close to 0. Say we have a long call. We know that's going to have a positive delta. And as the option moves deeper in the money, which means in our favor, delta is going to magnify and move closer to 1. Whereas the inverse is also true for a long put. If the option moves in our favor, so the underlying security goes down, Then delta is going to magnify, but to the negative end as we get closer to our destination. So what does that tell us? Whenever we're long options, we want them to magnify because that means they're directionally moving in our favor. Now let's bring that back to our events, the long call and the long put. As the underlying security or the stock moves up in value, that has a positive effect on the long call. That, of course, would have a negative effect on the long put. But the inverse is also true. As the stock goes down in value, that's going to have a negative effect on the long call, but a positive effect on the long put. But the outcome means that each corresponding delta is going to magnify as it moves in our desired direction. That's why bullish strategies will always have a positive delta and bearish strategies will always have a negative delta. Put this to practice with an options chain. So you see, we're looking at Shopify with the 30 days until expiration. And as we go deeper in the money within the option chain, on the call side, you'll see as the call is deeper in the money, the options delta is closer to 1. And that's because it's moved in our favor. It magnifies when it moves in our favor. And then of course, the farther out of the money we go on the call side, the smaller the deltas are because we have a long way of movement until we're at our destination. And at the money options, so where the strike price is relatively close to the market price or near the money, those tend to have a 0.5 delta. How is delta used? Well, there's a variety of reasons, but let's look at assessing directional risk. So if we combine together contracts or even an entire portfolio, we can reveal if that strategy or portfolio has a directional bias of bullish, bearish, or neutral. And what's important about this is options can be utilized to capitalize in any type of environment. And we want to know what environment or what our strategy sentiment is so we can align that with our overall sentiment. For example, a covered call. If you own 100 shares of an underlying security, that represents a delta of 1. And if we sell a call against it, for example, at a 0.3 delta, we reduce our net deltas to 0.7. So now we have still a bullish directional bias, but we've reduced our directional exposure, which makes sense because we're capping our upwards potential when we sell a covered call. Another great example is an at-the-money straddle. So an at-the-money straddle is comprised by buying a long call at an at-the-money price. So if ABC is at 50, we want the strike price to be at 50, and a long put at the same price and expiration. You expect there to be a drastic movement in either direction, and you're going to capitalize on this movement in either direction. But if we're utilizing net deltas to understand our directional bias, you want to be neutral, which means you're going to capitalize in either direction. So if you have a traditional at-the-money straddle, your call may have a 0.55 delta and the put a 0.45, well, that's going to give us an indication that you actually have a bullish bias. So to truly create a neutral strategy with strategy and strike selection, we would look to have a delta that's relatively close to 0 or get it to as close to 0 as possible. Delta can also be used to assess traction or stock sensitivity. So think about the previous examples. As a long call moves in our favor, the deltas magnify and they get closer to 1. Well, an option that is at 1 means it starts acting like the stock. And so what that means is an option that's deeper in the money has more sensitivity to the stock's price, because an option with a delta of 1 means it's going to move dollar for dollar with the underlying security. Delta can also tell us, and most importantly, the probability of an option expiring in the money. Now remember, our goal for selling options is for the contract not to have any value whatsoever. So that means we want smaller deltas, or a 0.15 or a 0.2 delta, depending on your strategy. So an option with a 0.15 delta means that it has a 15% expiring in the money. And if we don't want the option to have any value or expire worthless, we want a smaller delta. Whereas on the other hand, if we have an option where we want it to magnify in value, then of course we would want a higher or greater delta. And of course, to put this all together, we're going to use our T chart. Calls are found on the left and puts are found on the right. Bearish strategies are on the bottom and bullish strategies are on the top. And what you'll notice is that bullish strategies either contain the right to buy or an obligation to buy. And then the inverse is true for bearish strategies. They contain the right to sell or the obligation to sell. You'll also notice that long options are going to benefit from a strong directional movement in the desired direction. And time is something that works against them, which we learned in our events. And for short options, they actually profit from neutral or a small directional bias, and time works in the favor of short options. So therefore, utilizing this quadrant, all bullish strategies are going to have a positive delta, and bearish strategies are going to have a negative delta. And this chart is extremely important because everything is essentially a mirror. And the way that we teach at OptionsPlay is we focus on the long call, expand from there, and understand strategy drivers utilizing this chart, and you'll be able to put together the puzzle seamlessly. Let's look at Theta. Theta tells us how much does my option lose in value each day as the option nears expiration. So it's a daily time decay value that is expressed in dollar terms. Now that does assume that all factors are remaining the same. So for example, if we have an XYZ call with a 0.3 theta and another XYZ call with a 0.6 theta, that means as one day passes, the 0.3 theta call is going to lose 30 cents per day, and the 0.6 theta call will lose 60 cents per day. This is why theta values are represented by dollar values and can be any number. Higher price securities are going to have higher theta values. Now, since this is something that is decaying, that means theta is going to be negative for long options and positive for short options. It favors the sellers and does not favor the buyers. And that makes sense because theta means decay in premium, and that's going to benefit us if we sold the option by allowing us to buy it back at a lower price. But it hurts us if we bought the option because that daily time decay is something we have to overcome, and the goal of those long options or those options that we're buying is to sell at a higher price. Let's bring back those events, the long call and the long put. So as time, or there's less time until expiration, this has a negative effect on both the long call and the long put. And as time moves on, theta will actually magnify. And what this tells us is as the option nears expiration, it has more decay, or theta accelerates, which is something that we need to capitalize on when we are buying options. That's why we say never hold an option until expiration, because of that theta decay. And what's important to also know is theta decay is not linear. The option loses value on a daily basis, and the closer we get to expiration, it continues to lose more value and more value and more value. And that theta crush, it's like it falls off of a cliff about 14 to 21 days until expiration. So something that we want to overcome as option buyers, and something that can help us as option sellers. Let's look at the same option chain of Shopify, and what you'll notice is theta is centered around at the money options. So theta doesn't only represent time value, but it also represents extrinsic value of the option. And that extrinsic value component is centered around at the money options, or in other words, options that have the same price as the market. And this makes sense. As the option moves deeper into the money, we know that delta magnifies and the option begins to act like the stock. So it's at its destination and that extrinsic value is depleted. And the same occurs if you're really far out of the money. Yes, the options premium is made up of only extrinsic value, but you have a long way to go before it's actually profitable. So how do we use theta? We can use theta to assess our extrinsic value exposure. And this is really beneficial with multi-leg options. We know long options have a negative theta and short options have a positive theta, but theta is also centered around at the money options, which means the way that we structure our multi-leg options, we want to utilize our knowledge of theta to minimize anything that has negative effects. For example, a bull call spread. A bull call spread is comprised of a long call, and we want that call to go up in value as much as possible to the short strike with the same expiration. Now, the reason for creating a bull call spread is we reduce our premium, but we also want to reduce the negative effects that we have on our long call, which is theta exposure. So by properly structuring this, we can reduce our theta exposure or extrinsic value purchased, which maximizes our reward potential because we're paying for less in exchange, of course, for a capped outcome. Let's, of course, bring this back to our 4 quadrant. And what you'll notice is both long calls and long puts have negative theta, and short calls and short puts have positive theta, and that's because of the effect of time or the extrinsic value component. Time hurts long options regardless if it's a call or a put, and helps short options regardless if it is a call or a put. Let's look at my favorite, gamma. Gamma tells us how much does delta change when the underlying security changes. So just like the underlying security moves, delta is going to tell us how much the premium moves. But as the premium moves, delta gets a new value, and that new value is assigned to delta by gamma. Makes sense, right? Let's put it together. So for example, if we have an XYZ call with a 0.02 gamma and another XYZ call with a 0.08 gamma, if XYZ moves up by $1, that means the 0.02 gamma call is going to move delta up by 2 cents and correspondingly 8 cents for the 0.08 gamma call. Gamma is measured much like delta on a scale from -1 to +1, and that's because it's a derivative of delta. Remember, the goal of long options is to have as much value as possible, and as the options have as much value as possible, that means that delta magnifies. They're at their destination, or the long call is, when it's at +1, and the long put when it's at a -1 delta. Gamma is the acceleration to the destination. So therefore, gamma is going to be positive for long options, regardless if it's a call or a put, and it's going to be negative for short options, regardless if it's a call or a put. And that's because that acceleration is going to be good if we're buying, because we want to get to that destination, whereas if we're selling, that equates to risk, because when we're selling, we don't want a sharp directional move. We actually have a slight bias, but we're also profitable if we're even neutral. Now, if we look at our events once more with the long call and the long put, as the underlying security moves in our desired direction, so moves up, that will have a positive impact on the long call. And as it moves in the desired direction of the long put, move down, that has a positive impact on the long put. So that is why gamma is positive for long options and negative for short options, because it gives us acceleration, or the convexity is positive when it moves in our desired direction. Now let's look at our Shopify option chain once more and look at the at the money, deep in the money, and out of the money calls. Gamma is also centered around at the money options and is very minimal as you go deeper in the money or if you go farther away from the money. And this makes perfect sense. If we have an option that is at the money, we know that's going to have a 0.5 delta, which means it's got a 50% probability of being in the money or not, right? Well, gamma is very high because it can accelerate in the money or not. Whereas if we go farther out of the money, options that are very far away from the current market price, there is very little gamma because we're in terms of a bicycle. We have very little acceleration because our destination is that +1 and we have got a very long way to go. And then gamma is also minimal when we're at our destination because we're already there. Therefore, gamma doesn't need to do its job anymore. Gamma's job is to get delta to 0 or 1 at expiration, which means the option has value, a delta of 1, or no value at all, which is a delta of 0. So therefore, when we're buying options, we want to put gamma in our favor because we want to accelerate to our destination. And gamma is centered around at the money options. That's why sometimes it doesn't make sense to buy those farther out of the money options. They seem more lucrative because they're cheaper, but it's also difficult for you to get to your destination because they lack acceleration. So how is gamma actually used? It can give us sensitivity to the underlying. And you can, just like with Theta, combine strategies together and reveal if you have a positive or a negative gamma. It can also give you an indication if you should close your strategy or not. And I really think a great example is a bull call spread. So if you're constructing that, remember gamma is centered around at the money options. So if we have a bull call spread at a 100 strike price, the leg that we're buying, and the leg that we're selling at 110 strike price, we're going to have the higher gamma when this is constructed if that 100 strike price is at or near the money. But as the option contract or strategy moves to max profit, which is when the underlying is above 110, gamma will actually turn negative because now it's turned into risk. If the underlying moves down, we could lose max profit. And it's a great example of how the Greeks can tell us it's time to close our strategy, or perhaps we've taken on more risk. Now let's bring up our 4 quadrants and plot gamma. Regardless if it is a call or put, long options will have positive gamma because the payoff profile is positively convex when the underlying security moves in our desired direction. Or in other words, we want some acceleration on our directional movement because we want to get the option to having as much value as possible, which is what happens when long calls are magnified towards 1 and long puts magnified towards a negative 1 delta. So they have a positive gamma. On the other hand, short options, regardless if they are a call or a put, have a negative gamma because that sharp directional movement is risk. These strategies, even though they have a directional bias to the bull side or the bear side, they still can profit in a neutral environment. Therefore, sharp directional movement equates to risk. Now let's look at Vega. Vega tells us how much does volatility affect my option? And that's important to know. Are we sensitive to high volatile environment? Vega, not to be confused with implied volatility, but Vega actually measures the change in implied volatility. So if implied volatility were to move by a 1% point change, Vega tells us the effect that that has on the options premium. So for example, if we have an XYZ call with a 0.17 Vega and another with a 0.1 Vega, that tells us if there's a 1% point change in implied volatility, the call with the 0.17 Vega will move the premium up by 17 cents. And then of course the 0.1 Vega 10 cents. How is Vega measured? Vega is expressed in dollar amounts because it tells us the literal dollar change from a 1% point move and implied volatility. So therefore, since this tells us a movement and it can make the premium go up in value, Vega is positive for long options and it's negative for short options. And that makes sense. If we're buying options, we want the contract to go up in value as much as possible. And that includes an increase in implied volatility. If we purchase the option and then all of a sudden it experiences an increase in implied volatility, that's going to make the premium go up in value, even if the underlying remains the same. So therefore, that can help long options, but hurt short options. And that's how we can utilize Vega and our understanding of volatility to create optimal environments aligned with optimal strategies. Vega is also centered around at the money options, as you can see again on this Shopify options chain that all represent 30 days until expiration. And Vega is actually more sensitive for longer dated options. How is Vega actually used? Vega is used to assess volatility exposure. We know long options have a positive Vega and short options have a negative Vega, and Vega is centered around at-the-money options and has a larger impact on longer dated options. So we can combine together strategies or even portfolios to reveal if we have a negative or positive volatility exposure. A great example is volatile times. Remember, options benefit from an increase in implied volatility. So if we expect an increase in implied volatility, that's an optimal time to go long. Whereas if we expect a decrease in implied volatility, then that's an optimal time to go short. And that's how net Vega can give us an idea if we have exposure to volatility or not. We want to structure our trades in optimal environments. Let's bring back our 4 quadrants and add Vega to the chart. So calls on the left and puts on the right. Vega is going to be positive for long options regardless if there are a call or a put, because an increase in implied volatility means a subsequent increase in the options premium, and we want the options premium to go up in value as much as possible if we're buying options. So therefore there's a positive value on long options. And then the inverse is true for short options. An increase in implied volatility will make the premium go up in value, which hurts us if we sold that option. We want to sell the options when implied volatility is already high. Therefore, we want to have a negative volatility exposure when we expect volatility to come down. If you're not a member of OptionsPlay, we encourage you to give us a try. It's free for 30 days. We hold weekly educational sessions on Thursdays, sometimes even more throughout the week. We provide macro views so you can get an idea of confidence with market direction and what to look for. We also have daily plays and a tool that's reimagined for your entire OptionsPlay experience and options trading experience, where you have ideas that you can validate with technical views and lots of wonderful insights in addition to comparing and contrasting strategies so you can focus on risk versus reward. So certainly give us a try. Thank you again. Make sure that you comment with any questions that you have, any content that you want to see, and of course, like and follow us for more. Thank you so much.